Here we have Charles again from Capriole Investments. And if anyone knows Capriole, they are one of the leaders when it comes to fund management from a quantitative aspect, which is very advanced, and the results from the fund prove it for themselves. So, Charles, it's so good to have you here again, mate. Like last time, kid in the candy shop, we got Sam, our head analyst, on the line with us. We are obviously wanting to understand your perspective on a number of things from Sammy's put STRC. He wants more insight and guidance on, but from the bigger picture, really investors want to know, where are we at? I don't like using this word. I've told our clients to erase it from their investing. Are we at the bottom? I like to call it an area of value, because then it gives people more opportunity to get in and shift their mindset of trying to pick the bottom all the time or the top. But yeah, keen to really get more clarity on what data sets you're looking at, where you see that we're at based on that data, any risk, pros and cons of that, and what you're focusing on for the most part, which I assume is going to be the typical things. But it'd be nice to actually have that list for investors where they kind of tick off and it's like, yes, I'm watching this, yes, I'm watching that. And before we get started as well, we are loving your platform, by the way. We use the Capriole platform almost every day, and we're just watching everything from the flows. And Sammy pulled up a really interesting chart about the averages of treasury buy-ins, the high, medium, low. And I ran a couple of sessions in Melbourne, and I was showing the guys how we think it's just the retail investors that don't know what they're doing. And then you look at the ETF and treasury inflows and outflows
Yeah.
based on the Bitcoin that's being produced every day. And you see they buy the top and sell the bottom.
Yeah, that's it.
So, yeah, welcome, mate. Thanks so much for taking the time out of your day to be here.
No, pleasure. Look forward to going through all that and appreciate the generous introduction. Yeah, there's lots of updates coming out in the charts platform in the last week and also this week. So there'll be lots more to come.
Love it, mate. Awesome. So maybe let's start at the top with the real basic stuff of, where do you think we're at and why do you think we're there? And the core of this would be, what's the data that you're looking at to back up your assumptions?
Yeah, is this Bitcoin or
Yeah,
more broad?
let's start with Bitcoin.
Yeah, I mean, Bitcoin, I think you could summarize in a few words as it's close to the bottom than the top. So broadly trending within a value range historically in terms of on-chain data and metrics. It's got the perfect backdrop on a macro perspective. You just have to look at gold, but it's obviously not reacting to that. Um, that said, it's not at the deep value range that would be really exciting for me that we've seen in prior cycles. So I think if you're buying and holding for multi years, you probably can't go wrong here, provided the quantum stuff is solved, which we can talk about separately. But if you kind of want to navigate it a bit more and manage drawdown, historically we've always spent time in the production cost band range between electrical and production costs. That's basically the cost it is to mine a Bitcoin. Every cycle, every 3, 4 years, we've spent months in that range, and that's between 50 and 60K today. So I'd get super excited in the low to mid 50s. We may not, you don't have to go there, right? There's no requirement. So you don't want to just position to wait only for that. So for example, we have a very small but long Bitcoin position today, but it would get really exciting, I think, if we got down to the high 40s and 50s. That's it there. Yeah. So yeah, long story short, we're in a value zone, but as with any asset, equities, anything, you can be in a value zone for a long time. So you want to see some kind of confirmation for strength. And that could be either really deep value, so a big drop, or it could be just a change in market structure. So, strong price outperformance relative to other assets, a big technical breakout, or some change in flows on chain, whether that be significant ETF buying or treasury buying or something like that. And we just don't have something convincing there yet. So I think depending on your strategy and risk tolerance and timeframes, everyone's approach to investing is different. But you probably can't go too wrong on really long-term horizon with some exposure, but it's not yet really exciting for me. Yeah.
Yeah, and this highlights exactly what I was saying earlier, how it's not just retail investors that are buying the top and selling the bottoms. This is the ETF flows and the average between ETFs and treasuries as the blue line. And it really mirrors the peaks of the euphoria. And then when we get into the max fear, the guys are bleeding the bottoms. And the outflows are really quite significant against the daily production of 450 Bitcoin through this level here. So, what do you see on this chart? Obviously, we've gone through that deep red, and now we're trending up quite aggressively. Is this one of the key signals that you're watching, or one of the key tools you might say in your tool belt that you're watching very closely to make those decisions?
Yeah, I mean, this is definitely one of the most important Bitcoin metrics, I think, today.
Mm.
In the top few, I would say. So yeah, as you said, it's the net institutional buying, the sum of all the treasury companies, there's 200 of them, and all the ETFs in the US. And if it's net positive, especially if it's above the amount of Bitcoin that's mined per day, so it's greater than the organic supply, then that is really, positive. And we've seen all the major price appreciation when that's net positive. So that's something to be, that's just, yeah, that's definitely an optimistic factor. That said, all the ETFs and treasuries are still trading, as you mentioned earlier, at below their cost basis. That are all, not all of them, but 80% are at a loss. So yeah, I mean, it's typical bear market vibes. If we can see continued strength in that institutional buying, if it trends higher or if it maintains its position for a long period and we don't move down in price, I think that would be also a strong signal. So it's only just gone up in the last few days. Like if we see that hold for call it a week or two and price is still above 70,000, I think that would be a pretty strong signal that, we might have a solid base building here.
Yeah, great. And I'm glad that you mentioned that because I was just going to ask, you've mentioned the low side targets. Would you flip here at any point?
Yeah.
You mentioned 70K a couple of weeks is what you're really wanting to see. If that happens, and you might not necessarily want to say percentage of your portfolio, but would you start to get a bit more aggressive at that point as an investor and maybe drop the expectation of those lower levels being tagged? Hey there, I hope you're enjoying the webinar with myself, Sammy, and Charles. There are some killer insights in here that's going to help you to shift the way that you approach the market and also the results that you get from here. Now, I just wanted to jump in really quickly and talk about our VIP immersion program. If you're not aware of this or what it is, a high level overview, it will enable you to start looking at data and remove emotion, but have that support and backing to achieve the results and outcomes of what you're looking to get. We are the highest rated on Trustpilot for a reason. Our clients are making serious wealth, 56 million in recorded client profits, which you can see by jumping on the link and learning more about the success stories that our clients get. But really, the program helps you to take that massive step into I am empowered. I'm in full control. I know how to build a strategy. I know how to select assets and what to do. I know how I should be structured and set up because I've got tax partners to give me insights and guidance on that. I know how to buy cheaper crypto because I'm partnered with discounted rates. And I'm also part of an incredible community of people who have actually made money in crypto. And I get lifetime access to things like the support graduates group as well. So there's so much behind it that can help you to really reshape your financial future. So instead of guessing and gambling, are we at the bottom? You start saying, okay, this is an area of value, but here's why. Here's the data sets. And we give you the ongoing insights and guidance alongside weekly videos that I share to keep you guys up to speed. And you get access to our premium newsletter, weekly releases to give you that support and guidance as you go through and up level your insights and education in the series. Anyway, guys, enjoy the rest of the webinar and jump on the side, click the link to book in a call with the team and learn more about the VIP program. That's all for now. Enjoy.
Yeah, exactly. So again, we don't have to see them. I'd probably get, if we held here or even went higher and those flows remained really strong, I'd I'd definitely probably be short-term bullish. I don't know if that could be that could just be a mean reversion to mid 70s or low 80s. And then, that's where the current resistance is, I suppose, on a technical basis, I would say, on a high time frame basis. So we could get a rally to 82K and it could still be bearish.
Yeah.
So like I think line in the sand, I like the weekly level at 71. So if we can kind of close above that on a weekly 71 and a half, give or take, and we have strong flows, that would be, I think, pretty bullish for at least a several day multi-week move. But yeah, there's a lot of things that need to turn around here. Like a lot of price damage has been done, and that doesn't really resolve in a matter of days and weeks. It will take time. We've had a really aggressive sell off to 71K, and structure wise, that's quite similar to May 2022. If you zoom out a little bit in your chart, yeah, that dropped to about that one right there, 20. I think it's 24K in May 2022.
Yeah, just up a little bit, Joe.
Yeah, around it. So price structure looks really similar to that in terms of the way it's moved down, the magnitude it's moved down, the speed, everything is very similar to today. And even if you pull up the Bitcoin production cost, it's also sitting just above it, just like it was then. So value wise, yeah, exactly. So it just dipped into it in May 2022 as well, exactly like it has done today. So that looks really similar. Again, it doesn't have to do that. It could just stay here a while, grind around. It could just chop around for months and then recover, and production costs could rise as well with that. But given many of the other factors, like given the quantum risk factors, I think it wouldn't surprise me if we saw something similar. It's never going to look exactly the same, but it wouldn't surprise me. The quantum, I think, risk is a cap to upside here that we've just never had before. I honestly think we may not see new all-time highs until it's addressed by the core team, Bitcoin core team. So, the Ethereum Foundation has made it their top priority to resolve quantum. They've set up a team to work on it. Vitalik's openly said it's their top priority. Bitcoin core developers have said in the last 2 weeks it's not even in their top 100 items, like just which blows my mind. And we just have institutions and allocators talking about this openly as a reason to either deallocate or to reduce holdings. It's conversation comes up a lot in just private chats. So yeah, I mean, I think the opportunity there is actually skewed to the upside in that as soon as you get 2 or 3 or 4 core developers start talking about it openly, about solving it, I think we can get significant reprice into the upside. So it's not like something you would short or be bearish on, because I think nothing's happened. It couldn't get much worse. So only positive things can happen on that front.
I think as well. Oh, sorry, I was just going to interrupt, Charles. You were bang on, because when we were quite higher, you suggested the quantum threat needs to be taken seriously, and no one else was. And so you're a bit of a voice in the wilderness. And you also suggested that Bitcoin was maybe trading at maybe a premium.
Yeah.
With that in mind. And now we've had a pretty significant discount. So it is interesting. And I've seen the commentary on Twitter, and my goodness, do you get whacked over the head for just sort of stating the obvious, which is always, the complacency blows my mind, actually. But I actually think when, like yourself and others who, and I think Nick Carter is another one, you brought up the conversation to the front, and the more resistance you're getting, it doesn't matter, because it's actually bringing the conversation to the front and it's putting it in people's minds. So yeah, I think maybe, and I say maybe, but potentially we have seen maybe a bit of that hysteria move through, and maybe some of that marginal selling already happen. That's just a gut feel,
Yeah.
But obviously you're right. It's still a thing that needs to be solved. But yeah, what's your read around that?
Yeah, no, exactly right. I think the risk today is fully priced in. So there's no, given the percentage risk today, we have a metric on that platform as well, wrote an article about it, but that's looking at basically all the tier one quantum companies and all the quantum physicists where they're saying Q-Day will happen. Every single estimate is in the next 9 years, with most of them around 4 or 5 years from now. Like, that's the first factor which blows my mind, is like every expert in that quantum space is within 9 years, yet Michael Saylor says it's at least 10 years away. And the Bitcoin core team dismisses it. Everyone who has a 100% Bitcoin business dismisses it. And I think it's just incentives. But yeah, like I said a few months ago, we might just have to see a bear market for this to be taken seriously. And it's slowly being taken more seriously, but there's still a lot to do. But as you say, that said, I think the risk is all priced in today. So the opportunity is actually skewed to the upside because as soon as there's any traction on it, you get probably a significant repricing. And as soon as you got some of the top core team saying we're implementing or working on this code solution, I think the repricing could be massive. Like gold went up 11 trillion last year. We talked about Bitcoin's only 2 trillion. It went down, right? So it doesn't make sense. Bitcoin should be all else equal the better asset, but this is the only risk factor. And so as soon as it's addressed, I think we'll get a massive repricing.
Maybe you can just talk through on a real basic level, which I know that you touched on it last time, but what actually is the quantum threat? What does it mean for Bitcoin holders that are holding now? What does it mean for the Bitcoin that is lost on the blockchain, never to be found again until quantum emerges? Maybe you can just give us a real basic 101 for the guys that are listening so they can understand it.
Yeah, I mean, if your timeline's unlimited, a lot is at risk. So even the blocks and mining the blocks, right? But that's a long way off. So the nearer term risks are any public key that's been exposed in any format can be decrypted by a quantum machine, most likely within the next 6 years, give or take a couple of years, right? So that's the main risk. That's probably, well, we know there's 20 to 30% of coins are public key exposed. So that's Satoshi's coins and other lost coins, and they can be taken by a quantum machine. So that's something to solve. Then it's kind of two problems. Those lost coins or less active coins, which we don't know if they'll be managed at all. And then there's the active users like us who can migrate to new code. So essentially they need to upgrade the code to be quantum proof. And then we all need to migrate across to it. And then we also need to address, do we just let those lost coins be taken and probably sold on the market? Or do we establish something, another Bitcoin improvement proposal to essentially lock those coins if they don't migrate within some time frame of, say, 2 years? So all of that means like, I don't know if we'll ever get agreement in that second one, the sort of transition time frame. And assuming we don't, that means you've got sort of 10, 20, 30% of supply being unlocked in the next few years. And as we all know with altcoins, the ones that perform worst usually have supply cliffs and early VC investors dumping on the market. If you looked at every altcoin last year that listed on Binance, if you had a portfolio in them, your average return was negative 95%. So in just 1 year, 2025. So supply unlocks are really bad for price performance. And I just think that would be a really big bear market for Bitcoin. And then at the same time, you would just need to upgrade the current active users in the code, really within the next 3 or 4 years. And I honestly think there should be traction in the next 12 months on that. So yeah, I think all of that, you see institutions, I wrote a big article, people are interested on Substack. But multiple institutions have said they've taken out of their portfolio because of this reason. Van Eck said they'll walk away from it if they need to, if the risk grows. Vitalik and multiple other people have said that it's a real risk within 3 years. So, Jeffrey's head of equities, they've deallocated their 10% Bitcoin, moved it to gold and gold stocks. Kevin O'Leary, obviously a very popular guy, said quantum computing concerns are keeping institutions cautious and limiting allocation to 3% until it's resolved. So, and this is all in the last couple of months. So I just think the upside will be capped until there's tangible discussion and action by the Bitcoin core team, which hopefully is within the next 12 months.
Yeah.
Like capital has no loyalty, does it? I mean, especially dealing with
yeah.
these larger funds, if they see risk, they'll just cut risk. So yeah, I never got that argument that wouldn't have any impact in the short term. No, it absolutely does from a
Yeah.
payout standpoint and when assessing risk. So, can I just ask a quick question? I have heard some sort of short-term mitigation. It's not a silver bullet, but if you're using a wallet address like a SegWit or some of those other ones, which are spitting out a new public key each time, is that a short-term mitigation for quantum, or is that just a bit of
I mean, yeah, there's this argument that if you have perfect OPSEC
yeah?
and you only receive coins into new wallets, then you're fine, right? But firstly, who really does that? And if we're honest, I think it's almost no one. Some people would say they do, but it also means you can't send coins. Because as soon as you send it, that your public key is exposed. So like the network traffic collapses. It's just not a viable model. It's kind of like when we had Corona and they're like, we'll do mandate masks and 2 meter separation. Like if everyone was perfect, maybe it would work. But like that's not how humans are, right? Like it's just not viable in my opinion. And so best case, maybe you got 50% of that 70% of active users who does that. And I don't think that's even realistic. So you're still going to get the majority of the network basically collapsing in that scenario,
Yeah.
I think.
It's
Yeah.
trust. It's trust based, isn't it? It's the
Yeah.
robustness of the network. If you lose trust, then
Yeah, exactly. And then um it's like an avalanche, right? Like you get a few people exposed and then everyone panics and yeah.
We definitely have to grab the Substack link off of you so we can share that with viewers as well. Maybe you can share it after, and we can just chuck it on the side of the session, and then people can go through and read that because I think that the granular stats of those moving out is really important for people to know. That's data that I think everyone should understand and be across. And it's the if quantum does improve and it moves into the top 100, hopefully the top 10, and then the top three things that
Yeah.
the core development team focus on, it would be that beach ball being held underwater scenario
Oh,
that
exactly.
flip real
Yeah.
quick.
Yeah. Yeah, exactly. So opportunity wise, it's definitely positive, I think. Just the scenarios of what can happen from here. Yeah.
But it's an ongoing concern in the short
Yeah.
term.
Yeah. Like exactly. If we have this meeting in 18 months or 2 years and nothing's happened,
yeah.
You sell all your Bitcoin.
I won't have any probably. Yeah. I won't
Uh,
have any.
Let's touch on the liquidity in the US because I think that's naturally been a strong driver. We've got the interest rate decision coming up in a number of days now, which seems to be the statistics show that it's going to be staying at the same rate that we're at right now.
Mm.
What's your thoughts on US liquidity, expansion, contraction? I know that they've just gone through some treasury bill stuff. So where do we stand with that? And what do you see the short to midterm outlook on potentially quantitative easing as they mask it in many different forms now?
Yeah. Well, I'll just share, maybe go through a couple charts. You can
Yeah,
see
please.
that hopefully. Is that blocking the screen? Yeah. Yeah, so I think pre the Iran war is very positive. So if you just first think top down about policy, which is kind of more forward looking, obviously Trump really wanted to cut rates. He wanted to cap credit card interest rates, multiple things like that, which are pro liquidity. Treasury investment was with working things with MBS to lower rates. And then, of course, the Fed has two or three more rates priced in, targeting a 3% kind of terminal rate. So I think that's very positive, forward looking. And then if you look at the actual data today, this is global money supply, 117 trillion, and it's been growing at about 11% a year. Yeah, 10% a year at the moment. If you can net off the current cost of debt to get net liquidity, that's the treasury bill rate, and it's about 6%. And every time that is kind of net positive, it means it's easy to have access to liquidity. There's net liquidity in the market. Markets tend to do, on average, better when that's higher. That's especially the case with gold and Bitcoin as well. So all of Bitcoin's major bull markets have been when there's positive net liquidity. Obviously, that started to change when we speaking about these quantum risks and things recently. So net liquidity is great. Another good data point is USD positioning. This is basically all the Forex markets positioning on the dollar. And they've been net short the dollar for quite a while. And that historically as well has been great for risk assets because it's another way of trading that. When it's negative, you get the big price moves up historically in most cases as well. So um, again, that started to break down the last 3, 6 months on the back of the quantum stuff as well. So liquidity is great. I think Fed interest rate data is great. Um, and that's really supportive, especially of hard assets, typically. So equities, but even more gold. Um, and we're now in a sort of kind of a gold regime, if you will. So if I just look at this is gold against the ratio of gold to the S&P 500 down the bottom over a 200-week moving average. And when it's red, it means gold's outperforming. And we typically get those periods where it's red that last 5 to 10 years on average. Occasionally you get a blip like this, but the trends are usually pretty sticky and last mostly for 5 to 10 years over the last century. So we had that in 30s, 40s, 70s, 80s, 2000s, and more recently. And those regimes, like I said, they last a while, and given where we're at now, they can often go up another 150% on average. So gold would typically perform another 150% in the next few years, as long as that trend holds. I bring this up because if you look at equities in those same periods, they actually often underperform. So they can have low positive returns after that time frame ends, but they also have their biggest drawdowns as well. So it's just loading, but in the 1930s, obviously you had the 70% drawdown in equities. Here we go, 2008, you obviously had that 50%. You had a lot of volatility in the 70s and 80s too. And if you plot the returns on this, occasionally it's slightly positive, but often it's negative when gold's outperforming. So, a long story short is that if you forget the war for a minute, lots of liquidity in the market. That should be good for hard assets, especially gold, given this breakout regime change. And that also, in theory, should be good for Bitcoin when it can sort out some of its issues. Equity is a bit more of a question mark given this, given the hard asset outperformance. So that's really positive, I think, for those assets. Excuse me. But the war does change a couple of things. So typically wars are obviously, if you do the stats on every invasion or start to a war, most of the time they're actually positive for risk asset markets. And so that's actually a leading indicator for positive returns in equities. That said, when oil goes up and stays up for months, that can be really bad for equities. Druckenmiller has talked about this as well. So if you get like a 10, 20% positive return year on year in equity in oil and it stays there for months, then that's pretty much a big red flag for equity performance. So we're not there yet. It's still early, and there's obviously been a lot of volatility in oil, and maybe that will resolve very quickly. Trump says the war will end in a few weeks. I believe it when I see it. But so that's just something to keep an eye on, I think, is what I'm saying. Like if we see oil above 90, especially above 100, is really a historical kind of level that things get rocky. If oil is above 100 for weeks in coming weeks or months, then that would probably be a big red flag for equities, and it would actually line up with this relative gold outperformance, right? You get a lot of the downside volatility and risk in equities when you have these gold regimes. So yeah, it's really important to look. That's why we look across all these metrics and markets, because everything is interrelated. Actually, in that article I shared that we discussed earlier on quantum, but if we just look at gold here in yellow and Bitcoin in blue, and then the correlation between gold and Bitcoin, it's always been positive, except for a year in 2016. And in that year, Bitcoin went up a lot. And the only time it's been negative and Bitcoin's gone down is the last 12 months. And that's also lined up exactly when the first Bitcoin Quantum Summit was. And Bitcoin's obviously massively underperformed. So, uh, yeah, so some unusual behaviors happening, I guess, is what I'm trying to say with Bitcoin. Um, but yeah, pro gold, pro hard asset market environment, quantum stuff gets sorted. I think this will be great. We need to watch oil and other assets like that for equities. But yeah, so everything is interconnected, and it's important to track all these things.
And
And
just
sorry,
sorry,
go on.
you guys, Sammy. Otherwise,
Oh,
I'll
cool.
ask
No,
every
no, you're all right.
question.
I was gonna say pulling that apart a bit more. It does sound like this is a road hump. Again, it depends on oil because the infrastructure over there is getting pounded, probably a lot worse than what Trump wanted, which obviously takes capacity off the line. But it did seem before the war we were headed into a pretty obvious period of AI deflation, or across the board there was the deflation was really coming. And now with this spike of energy-borne inflation, it's putting everything on the back burner in terms of liquidity because they can hit the market with a ton of liquidity before this happened,
Mm.
and it probably leads to more liquidity and spending and printing and doing all that they wanted. But it throws like a Russia Ukraine or a COVID-esque spike in the works before. But then you've got that weird underperformance versus gold with Bitcoin, and Bitcoin's essentially been the only thing that's been down and been following software. So are you kind of that view that we're heading into a period of pretty serious AI deflation? It already seems like it is, and maybe this is a road hump of inflation before we get to that.
Yeah, I mean, we could talk about AI a lot. Um, yeah, it's pretty. There's been also, I feel like, a huge step change in AI in the last 2 months alone. So we use it in everything we do. All the charts, we have AI-based strategies, which are processing everything as well. But there has been a huge step change just this year in its capability. Like it can process maths now perfectly, like en masse across hundreds of thousands of records, which it couldn't do a year ago. Like that's huge. So Elon reckons his AGI will be in 1 year. It's pretty, he's a bit aggressive in his timelines often, but
Mm.
if he's even close, we've got huge disruption across many industries coming. Um, so yeah, so in that regard, I think, it could be some deflation, but I don't know, like it depends how it impacts jobs as well, right? Like if people have less jobs, then in theory, over a multi-year horizon, then maybe that effect will be hard to predict in terms of deflation. In the nearer term, I think there's probably, if the oil price stays or goes higher, there's more inflationary risk. Again, that may all resolve in a couple of weeks if the war ends and the strait opens up. But if it doesn't, that is going to be more of an inflationary pressure with oil prices. It's just what it does. Um, and that could actually have the opposite effect on the Fed. Instead of cutting, they may just pause, or maybe they'll even hike in the future. So we're in a bit of a gray zone. It's important though. It's very easy to start micro analyzing the war and where it's going to go and this, that, and the other factor. But unless, yeah, you're like probably in the Pentagon, I don't think you're going to have any, myself included, any meaningful insights there. And it's really easy to get bearish and concerned about the world and war. But if you just look at those stats, we could probably just Google like S&P 500 performance when there's a new war or an invasion. You'll see these tables and it's like all pretty much green to the right. So
Mm.
with the exception of one or two wars. So yeah, I think generally you should probably have a net bullish bias on investments like equities on new wars. But the main factor is just oil here, I think. Yeah.
Going back to gold, really interesting chart that you shared. I haven't actually been across the gold outperformance against stocks. I thought that was a really interesting perspective, and then how it lasts for a 5 to 10 year period. I think for a lot of investors that are looking at gold right now, and it's gone through significant performance for
Mm.
an extended period of time. But are you suggesting that you feel that even though we've gone through an outrageous run, is what I think is probably fair, because the extent of that growth and expansion in a fairly short period of time, but it's been consistent for a long time. It doesn't mean that it can't come down, but do you think this is still potentially going up and to the right against stocks which you still think are net bullish?
Uh, I mean, I think it's only just beginning for gold, yeah.
Wow.
Because of that ratio, like I can share screen again.
Yeah, yeah, please.
Um, so again, this is the ratio of gold to the S&P 500. It's only at zero point 0.7, call it 0.75 today. And in the 2000s, it went to 1.5. 70s, it went to 2.7. 80s, it went to 6. 30s, it went to 4 or 5, right? So that you can do the math. That's like a 7x relative to equities from here. If it's like the past, a 5 to 6x. Now, in theory, that could mean that gold stays the exact same and it just equities go down, right? So it doesn't mean price has to go up, and it could just be for whatever reason the whole world situation changes in a few months. This trend breaks down, right? So you do get short bursts, like I mentioned here, but generally the trends are sticky and they last for 4 or 5 to 10 years. So we're only about 18 months to 2 years in now. And relative, and again, that's the key thing here is everything's relative in the investing space and capital flows from one asset class to the other. So it doesn't really matter how much gold's gone up in the last 6 months. It's how much it's gone up relative to other assets. And relative to other assets, it's barely moved, like it just started. So that doesn't mean like I'm not saying go all in on gold. Like there can be a ton of volatility in gold still um, in those periods. So we had a very big position in gold last year in the fund, but we cut it in half basically in the end of Jan. So we're looking at a number of different factors for gold, volatility, and other fundamentals here. So our position sizing in gold, pretty much came down in half recently. That'll change month to month, but yeah. So like you have to expect volatility. If you, I wouldn't. You have to be comfortable with a certain amount of drawdowns. We could consolidate here for many months, but I think if your horizon is multi-years, for me personally, obviously not investment advice, but for me personally, it makes sense to have a good chunk in gold until this ratio breaks down at the least. Yeah.
And then obviously another key chart to watch is gold versus BTC strength, which in the short term seems to be somewhat topping out, um, or hitting an area of key resistance. But yeah, it'd be interesting to watch how that continues on, given the quantum threat and challenge that we're going through. That's probably going to cause some resistance here for gold to really break out. Therefore, sorry, for Bitcoin to break out higher against gold.
Yeah, I haven't looked at this in a while. But this is gold divided by Bitcoin. So obviously, since about August, gold's more than doubled against Bitcoin.
Mm.
Um, yeah, so I mean, yeah, it could be interesting to watch, especially if this was to turn down and to break down on some sort of time frame level, then that could be interesting for a relative sign of strength for Bitcoin. Um, yeah, no, good point. It's worth watching.
Nice. Sammy, any other questions that you had before we hand over to the guys to see if they've got anything they wanted to ask specifically?
Yeah, look, we may as well touch on one of the great parts of your platform, and that's looking at the treasury companies, which I find endlessly entertaining and fascinating in terms of what MicroStrategy is spinning out next. So just maybe some context. I think Sailor's been the buyer of first, second, and last resort now for quite a while, and his latest offering of STRC is getting a heck of a lot of buzz. I'm seeing a lot of volumes roll into it, and I mean, why wouldn't you? 10 to 11% was it paid annually? Excuse me, annually, and then it's paid monthly as well, which is above the S&P 500 return rate. So that's fairly
Yeah.
interesting. But I mean, that's a bit buzzy. I kind of wanted to see where you're at because I know I'm watching the MNAV really closely. I'm an investor in MicroStrategy. I'm pretty comfortable with that longer term thesis. But where do you see like the treasury companies? Where do you see MicroStrategy, and where do you see the preferred space as well?
I mean, just zooming out in the whole treasury company market, I'm pretty bearish on it. Uh, there's 200 treasury companies. Like you just use that's 198. Okay, so yeah, I think there are a couple of mergers. It was 200. But if you just think about it from forget everything and all the arguments from common sense, like, does it make sense to have 200 treasury companies? Do we have 200 gold treasury companies or 200 gold ETFs or silver or it doesn't make any sense, right? Like, you don't need that many. If they're effectively ETFs that are trying to get yield and in most cases or failing, right, and underperforming. So like there's no world in my head where there's 200 treasury companies in 10 years. So I think this whole asset class consolidates significantly. I think many of them will just shut down or convert into different companies, as we've seen the last month. The most I've been tweeting about this as well, but there's I think yeah 5 consecutive first sells from a treasury company. So the most ever in a row, and there's been no new treasury companies coming. So multiple companies have been shutting down, selling their Bitcoin. Um, I think probably a lot of them close. Some will get bought out when the discounts are good enough. And you might end up with 5, 10, or whatever the number is that continue, and they've essentially become Bitcoin banks, right? Where their yield isn't from these artificial products that are issuing debt to buy Bitcoin or equities to buy Bitcoin because it's a cap supply that's just not sustainable long term. I think they'll ultimately become borrow and lending platforms of some format, so like a traditional bank. So they might call themselves a treasury company, but they'll basically be a bank at that point. So yeah, so just on to micro, and yeah, they're all majority of them are trading at a loss. Historically, when they're at a loss in some format, that can be a good buying opportunity. So if you're bullish on Bitcoin, if you think it's in a value zone, all those things we've touched on, then it could be a good opportunity to buy some treasury companies that are trading at a discount to MNAV if you think it will survive, because you could have a thesis that once price goes up above cost basis, that MNAV gap will close and it will outperform. It's kind of like a leverage play. So there's an argument to that. So I can see a bullish case for MicroStrategy if you believe in what they're doing and if you think they're managing risk well. But I just, last cycle when these metrics perform well as bottom indicators, there was only like 20 or 30 treasury companies, and now we have 200. So it's a bit different now. The bubble can always get bigger. I often talk about the 1929 investment trusts, which were basically like Bitcoin treasury companies. There ended up being like 600 of them, and all they did was raise capital to buy equities. And they said that equities were limited in supply and all those sort of things. Very similar arguments to what they use now. They ultimately took on tons of leverage, like 5 to 10x leverage, and then they blew up, and that caused or drove a lot of the 1930s crash. We're nowhere near that risk today with Bitcoin treasury companies because their debt ratios are still pretty low. Sorry about the background noise. If you can hear it, it's my toddler. um, so debt ratios are still reasonably healthy, like comparable to a lot of traditional S&P 500 or stock-based businesses, but it's just something to watch because of the incentive structure of all of this. The current model for these companies is either issue equity or debt in some format to buy more Bitcoin. If your MNAV's at a discount, like most of them are now, most of them are trading at a loss here, the cost basis being around 80K for these treasury companies. If you're at a discount, then you can't issue equity because dilutive to your shareholders. You can only use debt. So all of them are incentivized now to leverage up to buy Bitcoin because if they do that, then they can say they've got a higher Bitcoin yield and they're growing Bitcoin at 10% or 5% or whatever their yield is, right? And the only way they can do that today is debt. And so the incentive structure for these 200 companies to stand out against each other is more debt. And that's why we've seen the debt ratios start to climb. Still, like I said, pretty reasonably healthy, but something to monitor because it's just, I don't see this being sustainable unless they convert to a different business model like lending and selling, lending and borrowing, that sort of stuff. So I'm not a big fan. I think they can be good short-term leverage plays. If you're an active trader, that could be good, but I'd be personally cautious about holding them long term for all those reasons. Yeah.
I love that. A really great deep dive on that to give everyone a bit more clarity based on data, the risks around it, because I think people are maybe just watching the MNAV and they see it as a great opportunity, but maybe don't understand other intricacies of it, which highlight greater risk with it. Coming back to gold, gold versus silver. Do you have any thoughts on the exposure across those two? Do you have a preferred? And if so, why?
Uh, I haven't really touched silver personally. Yeah, I'm a bigger fan of gold in this. If your thesis is between gold and silver, it's the same arguments really. I think silver's like the beta play. It's a smaller asset. It can go up faster. So maybe it's like Ethereum and Bitcoin, or something like that. So if you want to do trading and get higher returns, you can probably position more actively in something like silver and do well. I think there's some more risk long term if you're holding for long periods of time because silver is more easy to produce in higher quantities when demand and things go up. So I think that happened in the 70s or 80s, was a big run up in silver, and then like there was a lot of supply unlock effectively from the miners over a couple of years' time, and that impacted things. So it's not really as clearly the hard asset. Gold is just historically known as the number one in that space. Yeah, there's a lot more volatility and a bit more risk, I think, in that area. I don't have a lot more to add on that right now, but I think you can definitely find ways to invest well in it. But for me, I just have more conviction in something like gold.
Yeah, it makes sense. Do you think going back to the chart that you had there, where you saw the outsized gains, which was really following the 1971 Bretton Woods Act, I saw that that was a period where gold really expanded against the S&P 500. Do you believe the data is somewhat skewed because of that experience?
I mean, that in that case, you could argue that yes, but it's also the 1930s, 40s, 70s, 80s, and the 2000s. So 2000 to 2010, I think it was, or give or take on that
Yeah,
chart, you would have been better holding gold than equities. So
yeah.
yeah.
Yeah, and we're just triggering the start of that again.
Yeah, and equities had a huge run in that period too, in some of that period, obviously until the crash.
Yeah. We've got a question here. You mentioned institutional net inflows as a key metric for confirming a bottom. What other metrics are most important to focus on, and what signals in those would you indicate a bottom forming?
Yeah, so I'll just maybe run through a couple. If we focus just on Bitcoin on-chain data in terms of trying to identify value, um,
Yep.
my number one favorite is production costs. So we built this 7 years ago. I just hired some of the unnecessary stuff. But basically, the orange line is approximately the global average cost to create a Bitcoin by miners. It's at 61K, so they're still in profit today. When they're at a loss, when your price is below that, it's historically a good opportunity. And the red line electrical cost is just the pure cost of running all the electricity into the mining rig. So it doesn't even consider hardware, depreciation, overheads, warehousing. It doesn't consider any of that, just the electricity. So if Bitcoin's below that, in theory, your average miner should just turn off the power because they're losing money. Um, and so that's been a pretty hard flaw in the past. We dipped below it a couple of days in the COVID crash. We kind of tracked along it for a couple of weeks in 2017. We got close when FTX went down to touching it. So anytime you're in this band is pretty good value, and it's like an incredible opportunity at the red line. So for me, I'd get really excited about value in that region, and especially if we get close to touching it. That's the first one. Energy value is a similar take on that, but it's just looking at the raw energy input into Bitcoin, and then allowing for all the mining hardware efficiency to determine what's actually kind of consumed. And it's kind of that's it. That's it. There's no other. There's an art. If you want to read about the stuff, there's articles linked in every metric. But there's no kind of funky formulas or curve fitting. It's just literally the hash rate energy input and the energy efficiency. And that's really tracked a good fair value for Bitcoin over time. So that's one reason we're at pretty deep discount here at 38%, which again should be a great opportunity. Obviously, it's a bit less than that, I think, in reality, given the quantum stuff, but still a decent opportunity.
That's similar to Yardstick.
Similar to Yardstick, but yeah, Yardstick's even more simple. It's just hash rate divided by market cap, and it was recently at its lowest ever. So that's also pretty bullish on a value front. Then something a bit different, NVT. It's just a transaction throughput on the network on market cap, and this is kind of like a PE valuation measure for Bitcoin, if you will, kind of like for equities, a different way of valuing it through its utility. And it's trading at its most undervalued ever. Sorry, not ever, but undervalued in a long time in this green zone here. And it's historically there, pretty good price opportunities. So this kind of message is consistent across a lot of metrics. And that's why I say we're in a value zone. It's just like not deep value, because for me, deep value would happen if we're on production cost. Another good one is this is probably the oldest kind of long-term analysis metric for Bitcoin ever, Mayer multiple. It's just simple ratio over, I think it's 200 day price. Yeah. And every time it gets to kind of 0.6 has historically been a great buying opportunity. And this metric was built like 10 years ago or close enough. And, we just touched that recently. So that's pretty good. Again, could go lower, doesn't have to. So all these things, we're used to seeing a lot of extremes in Bitcoin, like last cycle when you get multiples of 2 and before that of 3, and volatility has compressed with time. So that's something to bear in mind, is that Bitcoin's a $2 trillion asset, or was a $2 trillion asset, right? And the bigger it gets, the less volatility it's going to have. So it's going to have less extremes both ways, you'd assume, unless there's something fundamental that breaks. And we've seen that volatility is compressed over the years. And so you're not going to get as many extremes that we're used to. So that's why I say, like, I'd be super excited if we get to electrical cost or low production costs, but you can't count on it because we just don't have to get there. There's no reason we need to get to ultra undervalued levels. So it's kind of like a scaling thing. That's why we have in the fund, our position changes day to day based on the data, but we do have a smaller long position on net at the moment. But yeah, it could get much more interesting if we go lower.
And I think it's a really nice place to finish, because I feel like we've done a bit of a full circle from the comment that I mentioned at the start of we're in an area of value. And it's not necessarily deep value like you've just shared, and as to why as well, but we're in an area of value, and that's something that investors need to take into consideration rather than waiting for the bottom kind of thing, and sitting on the sidelines waiting, and then you get to the bottom and then they wait further, and then the price changes the other way and they're chasing it up.
Yeah, that's it. Yeah.
Love it. Awesome, mate. Thank you so much for your time. And it's great to have our masterminds on the session as well, hearing this firsthand live from you as well. Question, so if guys want to learn more about the platform that you have or anything else that you do, where's the best place for them to come and find you or even follow you on different platforms too?
Yeah, so I'm most active on X. Capriole IO is my handle on X. But otherwise, yeah, most of the time just still building out these platforms and tools and strategies. So it's just at capriole.com and you click on charts. Yeah, we have a sale on at the moment on that platform if you're interested. But yeah, a lot of the metrics are still free as well, so you can just have a browse around. There's articles linked as well and a research page if you want to learn more.
Awesome. And we'll share the links to that on the side of the webinar in the playback anyway. Mate, thanks again for your time. And I look forward to joining you in the future on a future session and also hanging out when I'm back down in Melbourne.
Yeah, no, it sounds great. Let us know when you're here.
Awesome.